How do you avoid being house poor? With inflation, with market rising, interest rates all over the place, we're getting a lot of questions as to, how much house can I buy, or can I even afford a house? Okay, so we want to share some good rules of thumb to help you be wise in the decision of purchasing a home. Generally speaking, a good rule of thumb is your mortgage payment shouldn't be more than 25% of your take-home pay. Okay, so if you take home $100,000, you shouldn't be paying more than $25,000 or a couple $1,000s a month. Okay, and we'll show more specific examples of this later. So now your mortgage is not the only cost associated with a house. You also have taxes, insurance, etc. So when you bundle all that in, okay, that payment, which is housing related expense, okay, should not be more than 30% of your take home pay. Now I say that. Please understand that take-home pay can be calculated a couple different ways, but it depends if you get paid bi-weekly or semi-monthly. Okay, so make sure if you get paid bi-weekly, you multiply it out, okay, by your paycheck by 26 and then divide by 12, because that's your mortgage is typically only due once a month, right? So take those things into consideration. Now, disclaimer, we tend to prefer a 15-year mortgage. That's a whole different conversation, and we have a video on that, why 15 mortgage makes more sense than a 30-year mortgage as far as the interest that you pay over time and what you end up paying for the house. But, we understand that a lot of families can't enter a 15-year mortgage right away if they don't plan for that. So just want to disclaim that while we prefer 15, we're going to be saying it's okay and work on a 30-year mortgage for now. So here's some important considerations when determining how much house to buy. You want to make sure that when you're going to buy a house, you have 3 to 6 months of savings somewhere to be able to maintain the house. Once you get into it, a lot of people don't realize, oh, my utility bill went up. Now I'm paying more because I came from renting, which was, I was only paying, $2,000 or $1,500 a month in rent. Well, my mortgage is only going to be that much. Yeah, but there's taxes, insurance, high utility bills, etc. So take that into consideration when you're budgeting, but also have aside, after you buy the house, you should have net away 3 to 6 months of expenses that you will know once you do the budget for the new house. Okay, so that's a good rule of thumb. Something else, again, to make sure you do is calculate, again, your monthly take home based on whether it's 26 checks or 24 checks a year. When you're about to buy a house, you should also consider how much you're going to put down. This has a direct influence on how much your monthly payment is, because it's the balance that's going to be your mortgage. So if you're going to buy a house for $400,000, we normally recommend 20% down payment. Okay. Now that seems like a huge number, which is why we're doing this video. You need to plan to buy a house. Okay. So a 20% on a $400,000 home is $80,000. Now, because it is so high, a lot of people say, wow, that's a lot for me to get into a house. Why do we typically go there? Because 20% down payment avoids something that's called PMI, property mortgage insurance. It's basically the bank saying, we want to protect ourselves in case you don't make this payment. So we're going to add on this extra fee to get an insurance policy to make sure we're covered if you mess up. Well, that's a waste of money, obviously. Okay. But there are different ways, and you should talk to a planner or a mortgage person to get around this. If you can't come up with the $20,000, there's a 80-10-10 loan, which you finance $80,000 on a first mortgage, take out a second line of credit for 10%, and then and do the other 10% as your down payment. So different ways to finance that, but it is a consideration when thinking about how much mortgage and how much down payment to put down when you purchase a home. Another consideration is the timing of buying houses. Where are interest rates? As of the recording of this video, interest rates are relatively high, historically speaking, and that can make a big difference whether I should buy a house now or not, because interest rates does make a difference on your mortgage payment in the long term. So Jason, walk us through an example of how this can be considered if I'm looking to buy a house.
Yeah, so let's take a 35-year-old couple, Jamie and Josh. Okay, they make $150,000 gross household income per year. Now that equates to a $10,000 take-home pay per month. Okay, so every month they're bringing, after all taxes are paid, everything, they're receiving $10,000 per month. Okay, so just kind of high level when you're thinking about that, you can think $10,000 times 25% equals $2,500. But let's see kind of how much house they can afford based off of that. Now, we're in an environment right now where rates are pretty high. So for this first example, we're going to use a 15-year mortgage. Right now, 15-year mortgage rates are at around 6.5%. So if we take that, and let's say they only had enough money to put $10,000 or to put $50,000 down. So if they were able to put $50,000 down, then on a 6.5% mortgage that's 15 years long, they can still only afford a $2,500 a month payment, which means the mortgage amount is around 286. Okay, the house they can afford is 326,000. So this would be the ideal scenario from the standpoint of being able to get into a home where you're not house poor, where you can actually go on vacation and do things that you want. You're not just focused on putting everything into your house payment. But at the same time, you have to weigh that with, where I live, 326,000 doesn't get you much house. And so this is something you have to consider. And I would encourage those who, especially if it's their first home, to really consider, hey, maybe we don't go with our dream home to start off with. Maybe we start a little bit lower and we do it the right way, get a 15-year mortgage, and we can start to really pay down that equity quick. And then on our second home, we save up a little bit more, and then we can get our nicer home at that time. But let's just say you're in an area where you literally cannot find a home for $326,000. So from that standpoint, you consider a 30-year mortgage. So on this example, if we look here, a 30-year mortgage is going for 7% right now in terms of interest rate for a 30-year mortgage. And pay attention to that too, because the 15 years is at 6.5%, the 30-year mortgage is at 7%. I've seen times where the difference between a 15-year mortgage and a 30-year mortgage is as much as 1% difference. Okay, so that is something when you're doing your research you want to look into. You can't think about it as they're both going to be the same interest rate, because that's rarely the case. Right. Usually the shorter term one, the 15-year, is a lower interest rate, which makes a difference, and you'll see towards the end of this presentation. So if we look here, how much house can they afford? Well, they can afford more house now. It's still the same amount of payment. They can afford to make a $2,500 principal and interest payment, but the house they can afford now is up to $412,000. Okay, the mortgage would still be the $375,000. So if you look here at the bottom of both of these examples that we gave in terms of how much interest you pay, with the 15-year, you pay $163,000 in interest. With the 30-year, you pay $524,000 in interest. So over the life of the loan, you would actually save $361,000 if by going with the 15-year mortgage. But the point of this video is not just the 15-year over the 30-year. It's really thinking through, hey, how can we buy a house that we can enjoy? We're not going to be so strapped and so stressed, about being house poor that we're not able to do anything. Because naturally, when you buy a home and you move into it, you're going to want to furnish the home. You're going to want to do these remodels. You're going to want to change the kitchen. You're going to want to, you got this honey-do list that's like down here. All that costs money. And if you got into a home that you can barely afford, then you're not going to be able to do that stuff. You're not going to be able to travel, and you're going to feel strapped. You're going to feel stressed. And in a worst case scenario, you go through a really bad time, the housing values come down, and especially if you're in that 30-year mortgage, you could be underwater. Right. So we're trying to help you get into a house that you'll love, that you'll enjoy, but you'll also, you won't feel stressed.
So we hope this is helpful, and if it is, please hit the subscribe button below, and we look forward to seeing you soon.